Hello, everyone, and welcome to the Q2 quarterly webinar. I'm Matt Landon. I'm a CFP, CEO of Semmax Financial Group. I hope you brought a cup of coffee or water, whatever your beverage of choice. Not that you'll need it, because this is going to be exciting. So let's jump right in. There are going to be several market moving topics that we're going to talk about today and how they might impact your portfolio in the coming months. And I want to lead right off the bat with a little bit of a market recap. So this slide is graphing the S&P 500 index during Q1, and it overlays some major economic and political events. So I want to go through some of the key takeaways. The S&P 500, it started the quarter near 6,850, and it rallied through most of January. And it briefly touched an all-time intraday high of 7,000 the last week of January. Now, this rally, it was driven by a broadening in market participation. There were some small cap stocks and some value stocks that were really leading this rally. The rally was briefly interrupted on January the 19th. That was when the market sold off on tariff threats that was tied to Greenland, but equities recovered within a couple of days. The Russell 2000 hit its own all-time intraday high on January 22nd. That was capping a multi-week streak of outperformance over the S&P 500. And that's because sectors were kind of rotating a little bit. Investors were rotating into those smaller companies, and that was really based on optimism around rate cuts and attractive valuations. The Fed held interest rates steady. They stated that 3.5 to 3.75%. That was during the January 28th meeting. Kevin Warsh was nominated as the next Fed chairman, and that really was setting the stage for a leadership transition for later this year. But as I'm sure y'all were aware, the markets, they turned kind of volatile at the start of February. We saw a new theme emerging. That was around AI disruption. Starting the first week of February, a sharp sell-off hit the sector of software and technology, both of those sectors, as investors were worried about the new AI tools, thinking that they were going to displace a lot of traditional software businesses. The selling broadened over the next following weeks. It extended beyond software into financial services, logistics, real estate services, other industries. The S&P 500, it fell roughly 2.5% from its late January highs during the initial wave. It recovered, and then it sold off again in the following weeks as those AI disruption concerns started to intensify. Later in the month, the Supreme Court struck down the administration's tariffs. That removed the source of business uncertainty, and that briefly lifted stocks before attention shifted to the Middle East. And there's one thing I want to pause on and just say here is that the markets, they don't do well with uncertainty, with lack of clarity of where things are headed, whether we're talking about legislative risk, whether we're talking about tariff risk, whether we're talking about what's going on in the Middle East. And this quarter's defining event, it really occurred in the final days of February. This was when the U.S. and Israel launched military strikes on Iran. The conflict escalated rapidly. The Strait of Hormuz was closed to commercial shipping. That disrupted roughly 20% of global oil flows. Oil prices obviously surged from the mid-60s to nearly $120 a barrel at the peak on March 9th. S&P traded lower due to concerns that higher oil prices, that's going to slow economic growth. That's going to weigh on corporate earnings. Later on in the month, you see Iran's newly appointed supreme leader. He declared that the strait was going to remain closed. And then that pushed oil back near $100 and triggered another move lower in the stock market. The Fed decided to hold interest rates steady for a second consecutive meeting in March. The market started to discuss the potential for rate hikes. And that was because of oil remaining pinned near 100. And we've seen that even in the past couple of days. The S&P bottomed out on March 30th. Then it rallied sharply the next day of the quarter as Iran signaled more like a willingness to end the war. The index ended the quarter near 6,500. That was about 4.5% below where it started. The quarter began with stocks setting new highs as market leadership broadened, but it ended with rising uncertainty around oil prices, inflation, and really the path of Fed policy. So those are some of the themes that we want to explore and their implications for portfolios in the rest of this webinar. So if we go ahead and click through here, this slide is going to focus on one of the quarter's most notable themes. That's around AI disruption, the sell-off in the software industry. The software industry, it started declining in late October. It was already down nearly 8% in Q4. That's while the S&P and the broader tech sector were both slightly positive over the same period. The sell-off accelerated in late January and early February after a series of AI product launches. They demonstrated kind of the multi-purpose AI tools that could perform tasks that were previously handled by a lot of specialized software and really at a fraction of the cost. So the market's reaction to that was pretty swift. You saw software stocks fell first, but concerns started to spread to other industries, including financial data providers, commercial real estate services, logistics company. So at the end of the first quarter, the software index was down nearly 30% since the start of Q4. And this chart on the left, it really puts the sell-off into context. First of all, let me say this. I think charts are pretty neat and they tell a story. But let's talk about what this one does. The current sell-off, it ranks as one of the largest non-recessionary software drawdowns in the past 30 years. This surpassed the COVID-19 pandemic, roughly 26% decline. The only larger drawdown occurred during the dot-com bust and the 2008 financial crisis, both of which were occurring during recessions when corporate earnings were declining and businesses were cutting spending. The chart on the right tracks the S&P 500 software and services index, the S&P 500 technology sector, and the S&P 500. These were all indexed to 100 on September the 30th. The three lines, those tell a clear story about where the damages were concentrated. The broader technology sector, and you see this demonstrated in the gold, that has declined, but far less severely. So tech is down about 8% since the start of Q4, and that's due to the sector, including the semiconductor and hardware companies that benefit from AI infrastructure spending. But the thing is, the S&P 500 broad-based is down around 2% during that same period. Now, the gap between the software index and the S&P 500, that really illustrates how concentrated that sell-off has been. What felt like a market-wide event, that was largely contained to a specific corner of the market, and those diversified portfolios absorbed the disruption without significant damage. The big question that we have, like that broader question is really, how is AI going to reshape the software industry? And that's far from resolved. But this is really enforces why diversification across sectors and factors remains one of the most effective ways to manage uncertainty. When you think about the software sell-off, this was one catalyst that led to a change in market leadership during the quarter. And that's something that I want to talk about in the next slide. So this is comparing the performance of 6 major U.S. equity indices since the start of Q4 2025. We're getting into 2026. This is with all prices indexed to 100 on September 30th. The indexes include the S&P 500, its growth and value sub-indexes, the NASDAQ 100, the Russell 2000, and the equal weight S&P 500. Tracking all 6 on the same chart, it really highlights how different parts of the market have performed relative to each other. And this story, it's been a noticeable shift in market leadership. For most of 2023 through 2025, large cap stocks and mega cap tech companies drove most of the market's returns. With the cap weighted S&P 500, it was outperforming its equal weight version by its widest margin since the dot-com era. Now, this chart shows that dynamic started to reverse in Q1 as capital was rotating out of the growth factor or sector and into more value small caps and equal weight strategies. The Russell 2000 surged early in the quarter, and at one point it was up nearly 10% in late January, and it was posting strong outperformance against the S&P 500. Value stocks were also trading higher, and the equal weight broad S&P 500 outpaced the cap-weighted index, and that's an indication that market leadership was broadening beyond the narrow group of mega cap names that have been carrying the market. Several factors contributed to this rotation, including the Fed's rate cuts in late 2025. Now, that provided relief to the rate-sensitive smaller companies, wide valuation gap between large cap companies, and the rest of the market. Then you had expectations for continued economic growth in 2026. This rotation continued into late February. And this was really driven by concerns about AI disruption weighing on software and technology companies, which are disproportionately in growth and market cap weighted funds. However, as we all are aware, The backdrop really shifted in March as the US-Iran conflict sent oil prices surging, and that triggered a really broad risk-off move. So stocks were trading lower as concerns about high oil prices weighed on the outlook, with more growth stocks and the Nasdaq 100 holding up better than small caps and more value stocks. Now, the performance gap narrowed towards the end of the quarter, but it hasn't reversed. Values still lead growth by roughly 8.5% since the start of Q4, and the Russell 2000 is outperforming the S&P 500 by nearly 5%. The big question heading into Q2 is whether the broadening in market leadership from earlier in Q1 reasserts itself, or whether the geopolitical shock has reset the playing field. The rotation was built on fundamental and valuation grounds before the conflict begins, which suggests that it could have staying power. A sustained broadening would be a healthy sign for the market, as it would mean the returns are driven by a wider set of companies rather than that narrow group of mega cap stocks. So then let's jump into this. So this slide is looking at a key measure of economic activity. That's the ISM Purchasing Managers Index, or PMI, for both manufacturing and services. The PMI is a widely followed survey of business activity. Readings above 50 signal expansion, and readings below 50 signal contraction. The chart tracks both measures from the end of 2021 through February 2026. Starting with services, looking at the gold line, okay? The ISM Services PMI has remained in expansion territory for nearly the entire period of this chart. It only dipped below 50 two times since the start of 2023. Services have been the backbone of U.S. economic growth over the past 3 years, with consumer spending on healthcare, travel, financial services, technology. That's been driving activity even as other parts of the economy have slowed. The February 2026 reading of 56.1 is the strongest since late 2024 and the highest since July 2022, and that's an indication that the services economy remains on solid footing. The manufacturing story is very different. So the burgundy line here shows that the manufacturing has been in contraction for most of the past 3 years. That's spending 34 of the past 38 months below the 50 line. The contraction began in late 2022. That was as the Fed's aggressive rate hiking cycle, that was rising input costs, weakening global demand, that was weighing on the industrial sector. There was a brief touch of 50 early in 2025, but manufacturing slipped, and when it fell back below 50 for another 10 months after that. The false start in early 2025 is important context for what was happening earlier this year. In January 2026, the ISM manufacturing PMI rose to 52.6, and it held at 52.4 in February. These are the first back-to-back months in expansion territory since late 2022. Unlike the early 2025 episode, the current readings are meaningfully above the 50 line. The potential follow-through in the second month suggests that this is more than a one-month anomaly and potentially a significant development. For the past 3 years, the U.S.'s economics growth, it's been almost entirely a services story. Manufacturing's return to expansion, that signals a potential broadening of economic activity, which would be positive for the overall economy if the trend holds. The question heading into Q2 is whether manufacturing can sustain this momentum or whether it's going to fade like it did last year. Now let's jump into something that could cause it to fade: oil prices. This is looking at oil prices, which have surged to $100 a barrel, and that's due to the U.S.-Iran conflict and the effective closure of the strait. This graph it's charting WTI crude oil prices going back to 2006. And so I want you to see that long-term view of where prices stand today relative to history. The insert chart, if you look at it, it really shows you, it zooms in to show you that year-to-date price action and how quickly that move unfolded. But looking at the longer-term chart, oil prices have experienced several major spikes over the past 2 decades. If you look at WTI, it hit $140 a barrel in mid-2008. It traded above 100 for an extended period from 2011 to 2014, and it spiked over 110 in 2022 after Russia's invasion of Ukraine. In between those events, oil has experienced long stretches well below $80, including dips below $40 in 2009, 2016, and 2020. The current reading, near $100 per barrel, puts oil at its highest level since mid 2022 and marks only the fourth time in the past 20 years that WTI has traded near or above the $100 threshold. So the insert start, it really tells the story of how we got here. Oil started the year around $57 per barrel and was trading in a relatively narrow range through mid-February, gradually climbing into the low 60s. The spike began in late February as the U.S.-Iran conflict escalated and the Strait of Hormuz was closed due to commercial shipping. The Strait is a critical choke point for global energy markets, and I'm sure you guys have been hearing this in the news, but it handles roughly 20 million barrels of oil exports per day. Its closure represents the largest physical supply disruption since the 1970s. So prices surged from the mid-60s to nearly 100 in a matter of weeks, with extreme volatility along the way. The International Energy Agency announced a record 400 million barrel strategic reserve. That was a release to stabilize the markets. But honestly, the effect was short-lived as prices rebounded. The market's message was really clear. Reserve releases can bridge a short disruption, but they can't substitute for the reopening of the strait. Now, the surge in oil prices has had immediate implications for the broader economy. National average gasoline prices have risen almost $1 per gallon since late February. I'm sure when you went to fill up, you noticed it this morning. And these increases act as a direct tax on consumers and businesses. And as they complicate the inflation picture at a time when core inflation was already running above that 2% target that the Fed has, so the key question here is, how long is this going to last? If the strait reopens in the next coming weeks, prices are expected to normalize relatively quickly. Forecasters are projecting oil could fall back towards the $70 range by mid-year, but if the closure extends longer, oil prices could remain high and lead to higher inflation, fewer rate cuts, and reduced consumer spend. So, since we're talking inflation, here's a two-part snapshot of the inflation picture heading into Q2. The chart on the left graphs headline PCE and core PCE on a year-over-year basis going back to 2017. The chart on the right breaks that same measure into its two major components. That's goods prices and services prices to show where the remaining inflation pressure is coming from. So the takeaway here is that the dramatic improvement in inflation from its 2022 peak has been substantial, but it's incomplete. And the reason is due to a combination of sticky services inflation and rising goods inflation. The chart on the left is showing us that headline PCE peaked near 7% in the mid-2022. You see it right here, with core PCE peaking near 5.5 shortly thereafter. Both of these measures, they fell steadily throughout 2023 and into 2024 as supply chains were healing and energy prices were stabilizing. And honestly, that progress was encouraging, but the descent slowed noticeably in late 2024 and has since flatlined. As of the January 2026 reading, headline PCE sits at 2.8% year over year. Core PCE, the Fed's preferred measure, which strips out volatile food and energy prices, has ticked up to 3.1% from 3% in December. On a month-over-month basis, core PCE rose 0.4% or 40 basis points, 40 bips in January, and that was the hottest monthly print since early on, with the annualized rate running near 4.5%. So if this trend holds, the 12-month number could continue to rise in the coming months. And the chart on the right really explains why. Goods inflation, that burgundy line, it surged over 10% year over year in early 2022. That was due to pandemic-era supply chain disruptions that drove prices sharply higher. That wave has fully resolved. Goods prices spent much of 2023 into 2024 in outright deflation, and that was falling on a year-over-year basis, and have since stabilized around 1.3%. Goods have done more than their fair share of the deflationary work. Services inflation, the lighter line, that peaked around 6% in late 2026, and that has come down much more gradually. However, the descent stalled at around 3.4% in the second half of 2025, and the January reading ticked it up to 3.5. I'm sorry, it stalled at around 3.4, and then January it ticked up to 3.5. Now, the primary culprits are categories that are relatively insensitive to higher interest rate risks. Rates, that's insurance premiums for employer-sponsored plans, medical care services, specialized professional services, those all remain elevated. And here's the thing. The gap between those goods and services lines on the right-hand chart, that's the core of the Fed's dilemma. With goods normalizing and no longer providing a disinflationary tailwind, the burden of getting inflation back to 2%, it falls almost entirely on the services side, and that's where progress is stalled. One encouraging offset is shelter costs, the single largest services component, which recently posted one of its smallest monthly increases since early 2021. So if shelter continues to normalize, it could do some of the heavy lifting. However, the broader question is whether shelter relief alone is enough to overcome stickiness in insurance, healthcare, and other labor-intensive categories. The ongoing U.S.-Iran conflict adds another dimension. You've got surging oil prices likely to create additional inflationary pressures. The numbers in these charts are the latest data from January, which was before the conflict, and the concern here is that rising oil prices could push headline inflation back above 3%, and that's going to further complicate Fed policy. So here's the question of the day, or one of the questions rather. How many rate cuts are forecast in 2026? Now, this slide provides an update to the Federal Reserve policy, and it shows how that rise in oil prices and recent inflation data have combined to impact the rate cut path. It graphs the federal funds rate from early 2021 through today, with the shaded area on the right showing the market's forecast for the remainder of 2026. So that's this portion right here. This chart is including two forecast lines. There's the current forecast and then the forecast 1 month ago. That was the end of February. The gap between these two lines tells an important story about how quickly the outline has shifted. To recap the past couple of years, the Fed started to aggressively hike interest rates in early 2022, and that was in response to surging inflation. From March 2022 through mid-23, the central bank hiked rates by more than 5%, and that was one of the fastest rate hiking cycles in modern history. It held rates at that level through September of 2024. That's when it began cutting. Since then, the Fed has reduced interest rates by a total of about 1.75%, bringing the target range down to that 3.5 to 3.75. I kind of mentioned that earlier in this video. Now, this year, the Fed has held those interest rates steady at both its January and its March meeting, and the tone has really shifted towards fewer rate cuts. And the shaded forecast window, that shows how dramatically expectations shifted in March. As the year of February, that dotted line shows, the market was pricing in a policy rate of near 3.05 by year end, which implied roughly 3 rate cuts. Now, today, the dashed line shows where the market expects the Fed rates to end the year at around 3.56. That's only slightly below where it's sitting currently. The repricing reflects 3 developments. First, the U.S.-Iran conflict sent oil prices surging towards $100 per barrel, and that was raising concerns about energy-driven inflation. Second, inflation has remained above the Fed's 2% target, with the Fed itself raising the 2026 inflation forecast at the March meeting. And then the third thing was Fed Chair Powell's tone at the March conference was cautious, noting the committee wants to see more progress on inflation before cutting rates further. The market had expected multiple rate cuts at the start of this year, but is now pricing in the possibility that rates stay where they are through year end. The shift from when will the rate cut to will the Fed cut the rates at all in 2026 has had broad implications. Higher for longer interest rates, that's going to weigh on borrowers, everything from homeowners to small businesses to companies with floating rate debt. At the same time, the Fed is being cautious rather than signaling alarm. Its latest projection is still showing 1 rate cut this year. GDP growth was revised slightly higher, and the unemployment forecast was unchanged. Now, the key question is whether the oil-driven inflationary pressures, are they going to be temporary, or is this going to be more persistent? If the conflict is resolved and oil prices normalize, the Fed could cut rates later this year. If inflation remains elevated, interest rates could remain higher, and they can remain higher than the markets expected coming into 2026. So when you look here at the credit markets through the lens of the high yield credit spread, which measures how closely lower rated companies pay to borrow compared to the US government, it's one of the most closely watched indicators of credit market health. When spreads are tight, the market is confident in corporate health. When they widen, it signals the market is becoming more cautious about the economic outlook. So this chart It graphs that high yield spread going all the way back to 1996. And the pattern is clear. Credit spreads spike during crises. The high yield spread widened to more than 10% during both the dot-com bust back in 2001 and 2022, surging to nearly 20% during the 2008 financial crisis and approached 9% during the COVID pandemic shock in early 2020. Between these episodes, spreads have generally settled in the 4 to 6% range, with the long-term median around 4.5%. Today's reading of 3.28 is well below that median, but it has been rising since the start of 2026. The top right chart zooms in to show how credit spreads have moved over the past 15 months. Those spreads, they started near 2025 as cycle lows around 2.6%. Then they briefly spiked to 4.6% in early April 2025. That was as trade policy uncertainty was rattling the markets. This high yield spread then tightened back to the high 2% range in the second half of 2025 as trade deals were reached, global economy stabilized, and it remained near those levels headed into 2026. The recent widening began in late February, and that was as the U.S.-Iran conflict escalated and oil prices were surging. And this is pushing spreads from around 2.85% to nearly 3.5% in a matter of weeks. So the current spread of 2.85% is worth putting into perspective. It's above the cycle lows, but it is still well below the 4.5 long-term median, and it's far from the 5% or higher that have historically signaled systemic credit stress. The widening has been orderly, and it reflects the market repricing risk in response to geopolitical uncertainty and higher oil prices, not a fundamental breakdown in corporate credit quality. The key risk is how long the conflict's going to last. If the conflict persists and oil stays elevated, those higher energy costs, they can weigh on corporate margins, and that could push spreads wider. If the conflict is resolved, oil normalizes, history suggests that spreads would tighten relatively quickly, as they did after the tariff-related widening last spring. This is a metric worth watching closely in the next coming weeks. So let's take a closer look at the relationship between the S&P 500 price and the earnings that underpin it. And it addresses a question that many investors are asking right now. If the market's falling, are companies in trouble? The chart on the left, that's comparing the S&P 500's price level against its rolling 12-month earnings per share, and this is going back all the way to the year 2000. The chart on the right tracks how analyst quarterly earnings estimates for 2026 have evolved since September. So the chart on the left illustrates one of the most important relationships in investing. Over the past 26 years, the S&P 500 price and its earnings have moved together with a 96% correlation. When earnings rise, prices generally tend to rise. When earnings decline, as they did during the 2001 recession, the 2008 financial crisis, and the 2020 pandemic, stock prices tend to fall with them. What stands out about the current environment is that earnings have continued to rise even as the S&P has pulled back roughly 6.5% from its record highs in late January. On a near-term basis, the two lines are diverging in a way that signals the market is getting cheaper on a fundamental basis. The forward price-to-earnings ratio has fallen from 22 times at the end of 2025 to 19 times at the end of Q1, meaning investors are paying less for each dollar of expected earnings. The sell-off has been driven by a repricing of risk in response to the geopolitical environment, not a deterioration of corporate fundamentals. Now, the chart on the right tells a similar story from a different angle. It tracks the consensus earnings estimate for each quarter of 2026 over the last 6 months. The Q1 estimate, which you can see in gray, is mostly unchanged since September, and it's modestly lower compared to the start of 2026. The stability is notable because while it suggests analysts see some near-term impact from the conflict, they aren't forecasting a significant earnings decline in Q1. In contrast, the Q2, Q3, and Q4 estimates have all continued to trend higher over the same period. The upward slope of those lines suggests that the market expects the impacts of the conflict to be contained and temporary, an indication that analysts are projecting earnings growth in the back of the year. Now, let me jump back in here for one other thing, because there's something else I want to say here. Excuse me. The takeaway from this is that recent market declines, That reflects a valuation adjustment, not a fundamental deterioration. Earnings estimates are rising, companies are beating expectations, and profit margins remain healthy. The market's repricing for uncertainty around oil prices, inflation, and the path of Fed policy, but it hasn't priced in a recession or an earnings contraction. The next update is going to come in April as companies start reporting Q1 results and provide that first round of guidance that'll fully incorporate the conflict. If companies maintain their expectations for the back half of the year, the current pullback could suggest the market is trading at a discount to its earnings potential. If guidance turned cautious, the earnings estimates on the right side of the chart may need to come down. So let's look at the three major market themes that we need to watch over the next 6 months. The first theme is obviously the US-Iran conflict and its impact on oil prices. That can't be overstated. The US-Iran conflict has sent oil from the mid $20 range to over $100 a barrel. The Strait of Hormuz is effectively closed to commercial shipping. That strait handles roughly 20% of global oil flows, making this the most significant oil supply disruption in decades. Now, the key question is, how long is this going to last, right? If the conflict is resolved quickly, oil prices could start to normalize, the economic impact could be limited. If it persists, elevated energy costs could weigh on consumer spending, corporate margins, and inflation. The trajectory of the conflict will influence nearly every other theme discussed in this webinar. The second theme is the ongoing debate around AI disruption. It kind of feels like it's been lost a little bit with what's been going on currently with the conflict. But the software industry has declined nearly 30% from its October peaks as investors reassess which businesses are vulnerable to AI models and different tools. And I think it's important to remember that sell-off, it extended well beyond software. It went into real estate services, logistics, other sectors, and that was stabilizing in late February. So the core question here is whether AI is going to enhance existing businesses or if it's going to disrupt their business models entirely. Honestly, the market is still working out the answer, but we'll be monitoring releases of these new AI models. The theme could continue to be a source of volatility as more AI tools are released and companies start to develop their responses. And then the third theme is going to be around Federal Reserve policy. The Fed held interest rates steady at both its January and its March meeting after cutting 3 times in late 2025. The market entered this year expecting 3 rate cuts, but that's been repriced dramatically due to the US-Iran conflict, rising oil prices, and the threat of inflation. The key question is whether that oil-driven inflation pressures prove temporary or persistent. So the Fed's next move is going to depend on how long the conflict evolves, whether energy costs pass through to broader inflation, whether the labor market holds up. The answer to these questions will have direct implications for mortgage rates, borrowing rates, and the broader economy. Now, I hope this has been helpful. I hope it's given you a little bit of context to what's been going on. I think it helps to do this on a quarterly basis because the day-to-day news, one day you're seeing everything, okay, market's going up, everything looks great. Next day it's down. I think the broader question are these 3 key areas. Now, if you have questions, you are welcome to reach out. Please feel free to get in touch. Thank you, everyone, for joining us today. I hope this webinar has been insightful, along with the market teams. Our team's doing a great job of following things. We've been working hard to manage your family's wealth alongside of our own. And if you have current clients, if you have questions, give me a call. You can always contact us. You can always reach out. For those of you that are prospective clients, that you aren't current clients, you're welcome to reach out. We can schedule time to talk to you as well. This is just a chart of definitions that I think is pretty neat. So if you want to take a screenshot of it, feel free to look it up. But it just kind of helps give you some definitions you want to talk about. Thank you so much for being here today. It's been an absolute pleasure. I appreciate the time and I don't take it lightly. You have a beautiful day. Thanks for watching.